In today's video, we're going to talk about something that affects all of us, and that is income tax. Whether you're just starting out at your job or you're starting out your business, you're employed at a company, whatever, this is a topic, this is a tax that affects all of us. Hey guys, you're welcome back to my channel. Welcome back to Accounting with Liz, where we talk about all things taxation. So this is a series that we're going to do about income tax, and for the first part today we are going to talk about provisional income tax. Please grab your pen and notebook and let's get started. So as usual, I'm going to be answering questions that are frequently asked. So let's dive into our first question. What is provisional income tax? This is a tax on estimated income by an individual or a company. Here's how it works. An individual or a company estimates a certain kind of income that they think they're going to earn by the end of the year, and they file that return to URA and pay that tax in installments as the year goes on. So who is obligated to file for provisional income tax? Every individual or company that is subject to income tax is supposed to file for provisional income tax. But there are individuals that are employed in companies that pay as you earn. So if you are such an individual and you do not have any other side income or any other job, you are not subject to filing for provisional income tax, nor are you subject to file for a final income tax. However, if you are employed in more than two companies, even if they all file or pay as you earn, you are supposed to file provisional tax returns and final income tax returns. Next question. Isn't provisional income tax a form of double taxation? No, it's not. Because at the end of the year, when you file your final income tax, the amount that you paid in provisional tax is allowed as a credit against the final income tax that you pay at the end of the year. What does this mean? That when you file your final income tax at the end of the year, the amount that you're supposed to pay, we get that amount minus the amount that you paid in provisional tax, and the balance is what you pay. If you have no balance, then you don't pay anything. If the provisional tax that you paid is higher than the final income tax that you are supposed to pay, let's say you probably said you are going to earn a profit and then you make a loss, or you estimated an amount that is higher than what you actually got at the end of the year, the excess amount is still on your account as a credit, and the next time you have to file to pay for any other tax, you can utilize that credit from the excess provisional tax returns and use it to cover up for any other tax that you have to pay. Next question. What is the importance of taxpayers paying provisional income tax? Why not wait for the year of income to end? It is important for taxpayers to pay provisional tax, one, because it actually benefits the taxpayer. Why is this? Because when you file for provisional tax, you have a whole year to distribute your tax liability in installments. So let me break it down like this. For an individual, you can distribute your tax installment payments in 4 installments. That is in the first quarter, second, third, and fourth quarter. For a company, you can distribute your provisional income tax payment within 2 installments. That is within the first 6 months of the year and within the last 6 months of the year. So this benefits you, the taxpayer, because your tax burden is reduced. Instead of paying the whole tax amount in one lump sum, you are able to pay in installments, and that benefits you as an individual or as a company. Next question. How can a person determine or project income for a year that has just started? If you are a company that has been operating, or if you have been paying your taxes, probably you know how much you earn or how much tax you paid in the previous year of income. So you can use that as a projection for your next year of income. Option 2, let's say you are a new business, a new company, or probably last year you made losses. You can estimate, depending on how you are operating, the sales that you're making, use that to estimate and know, based on this, how much am I going to earn at the end of the year. So you use that and file your provisional income tax based on those figures. Next question. If a taxpayer filed a provisional income tax return, why file a final income tax return at the end of the year of income? A provisional tax return is just an estimate. So that means that's not an actual figure. You need to have an actual figure of how actually your business performed. So that is why we file a final income tax return, because this one is accurate. It shows an actual accurate figure of how you performed throughout the year. Our last question. What are the filing and payment due dates for provisional income tax? For an individual, your due dates are 3 months after the year of income. For every business in Uganda, the year of income is from 1st of July to 30th of June the next year. So that means September of every year, you are supposed to, if you are an individual, you are supposed to file provisional income tax. And if you are a company, you are supposed to file within 6 months after commencement of the financial year. That is by December of every year, you are supposed to have filed provisional income tax returns. So after filing the first return, you may, as you go on throughout the year, as you operate, you may realize that, oh, I may either earn more or less. So you can amend your provisional return. If you are an individual, you can amend in the next quarter and the next quarter and the next quarter. If you are a company, you can still amend in the next 6 months. That means by 30th of June, you file your second provisional return of what you think you may actually earn in that year of income. Thank you guys for watching. We've come to the end of part 1 of our income tax series. Don't forget to like, share, and subscribe for more videos like this. Bye.